Hello, and welcome to this Office of Clean Energy Demonstrations webinar on the Regional Clean Hydrogen Hub Program's Demand Side Support Initiative. I'm Kelly Cummins. I'm the Acting Director of the Office of Clean Energy Demonstrations, and I'm joined today by Leslie Biddle, Senior Advisor in DOE's Office of Infrastructure, Ramsey Foz from OCED's Portfolio Strategy Division, as well as Melissa Klambara, the head of OCED's Portfolio Strategy Division. We are excited to use this time today to provide some background on this initiative and share what we've heard from responses to a recent request for information on how DOE should design this program. As with all of our programs, we are committed to partnering with the private sector to get this right, and we are really grateful for the hours of effort that people put into these RFI responses. We also want to emphasize that this RFI is only the beginning of our engagement with you all on this important topic, and there will be ample opportunity to discuss the specifics of the demand side mechanism as we move into detailed program design towards the end of this year and into 2024. As you are all aware, our largest program in OCED is the $8 billion Regional Clean Hydrogen Hubs, or H2 Hubs program, for which we released a $7 billion funding opportunity announcement last November. We've been really excited by the tremendous response to this Hydrogen Hub funding opportunity announcement. The projects are incredibly ambitious, and they've been put together by truly impressive teams. However, there is an area that needs a little help to realize the full potential of clean hydrogen in this program and broader hydrogen scale up, and that is establishing reliable demand for clean hydrogen. This has come up in many conversations we've had, in the analysis we've done, the requests for information, every report that DOE has worked on and put out, and several third-party reports in the hydrogen space. The fundamental issue that hydrogen producers need multi-year purchase agreements to secure financing for big investments, and prospective hydrogen buyers are hesitant to commit to multi-year offtake as they expect prices to decrease. We've heard this from the private sector loud and clear, and we're setting out to do something about it. I'll let Leslie get into the details, but the headline is we will be using $500 million to $1 billion to provide revenue certainty for projects affiliated with DOE's regional clean hydrogen hubs. As I mentioned, we've offered $7 billion of the $8 billion we've had in the Hydrogen Hubs program. So this does not mean fewer hubs will be selected or that we're taking any money away from the hub projects. We've set this money aside in advance to deal with issues that arose in the hubs, a situation exactly like this. So I'm sure you're all curious about how the program will work. Well, it could look a lot of different ways, and we're going to be gathering a lot more input before anything's finalized. But a basic example would be DOE, through a third-party entity, could provide revenue certainty agreements or pay-for-difference contracts to hydrogen production projects that ensure that they achieve a certain dollar per kilogram in revenue for each unit of clean hydrogen produced, even if the market price fluctuates. Then either the entity or the producers themselves would go sign offtake contracts for a price the market is willing to pay, and the DOE funding would make up the difference. This would ensure producers have certainty that they can produce hydrogen at a solid price point, and end users will have certainty that production will be online and at a price they can afford to buy until the cost curve comes down as the market for clean hydrogen grows. We're also hoping the program can catalyze broader regional market development by providing price transparency and standard contracting terms, since we will publish the important terms of any support arrangement with projects. We want to run this program through an independent, not-for-profit entity. This means DOE won't be the counterparty with the projects. Instead, the independent entity will be the counterparty executing a DOE-funded and DOE-designed program. We think this will allow for more nimble contracting that will let more projects compete for this support. We are also evaluating this kind of approach for other clean energy technologies in OCED's portfolio that see the same chicken and egg demand problems as we see in the clean hydrogen space. We're focused on doing this right to support the success of the hydrogen hubs, And the responses we've received to the request for information we put out in July gave us a lot of very valuable input that we are working into the program. So with that, I'll pass it over to Leslie and Ramsey to share a little bit more about the program and what we've heard in the RFI responses.
Thank you, Kelly. I'm Leslie Biddle, Senior Advisor to DOE's Undersecretary for Infrastructure. To set out some context here, historically, we have seen supply lead and demand lag in nascent energy markets. This is especially true for industrial commodities, and it plays out over several decades as new industries scale up. But these conditions don't get us to where we need to be. A total transformation of the economy to reach our energy independence and net zero ambitions by 2050. Current market dynamics encourage the status quo. As our Undersecretary David Crane likes to say, no procurement officer ever got fired by buying energy this year the exact same way they bought energy last year. Through conversations with the private and public sectors and investors, we are putting forward a new market-based support mechanism to bridge this early supply and demand gap and to bring more stability to the DOE's hydrogen hub projects. Let's take a step back. DOE defines success in one way: massive clean energy deployment. We need a step change in capital investment, $10 trillion by 2050 to reach net zero. Deployment is how we measure success. Checking the box and administering our programs won't cut it. Each dollar we spend must stimulate many times that in private sector follow-on. The public sector alone cannot fund the energy transition here. Despite the growth we are seeing in clean energy projects, we need more investment. Capital markets have announced high-level pledges, but they must find investments that meet their return imperatives. The infrastructure law and climate law give us powerful tools, and they must unlock massive private sector investment. We need to turn billions to trillions. The only way that happens is with true market liftoff, where markets and technology are mature enough that they are the one that makes sense for private sectors and investors to get involved and scale. So how can we speed up this investment in clean energy markets? There is certainly the interest and commitment from private sector. Unprecedented money has been pledged to global net zero efforts. We need this from asset managers, asset owners, banks, and other financial institutions. But there is a consistent undershoot in capital investments in the energy transition relative to what we need. Many things could keep a project from being investable. Technology risk, operational risk, feedstock risk, but the one that we hear most frequently from investors is offtake risk. There are a lot of clean energy projects for which the technology and operation have been de-risked, but the sustained revenue picture remains unclear. The market for these projects is too immature. Projects are unable to secure long-term offtake agreements from a creditworthy counterparty, and there is not a deep enough spot or futures market to hedge out the price volatility. Without deployment, cost downs don't come, and markets don't develop. So we're stuck in this cycle of high prices in immature markets, preventing the deployment that we need. In the past, it's taken commodity markets decades to break this cycle. Natural gas, for instance, took decades to go from a waste product for oil production to an energy commodity in its own right. We know we need roughly $300 billion in incremental capital investment each year, and last year we did less than half of that. And we know that the portion of the gap is driven by the lack of reliable offtake and mature markets for clean energy projects. To achieve DOE's mission of massive deployment, we need to mobilize our resources to address this and get the private sector investing in the US energy transition at a $300 billion a year scale. Clean hydrogen is a perfect example of this chicken and egg. The IRA and other policies have created a lot of support for hydrogen supply, which have led to a wave of announcements and production projects. But demand is lagging, creating the risk that announced projects do not reach FID or will begin operations but shut down quickly, creating stranded assets. We've heard from investors, developers, and third-party reports that this is already a potential problem for the hydrogen deployment. As Kelly mentioned, DOE is tackling this issue as part of our investment in the hydrogen hubs. Of the $8 billion in appropriations, we're using $500 million to $1 billion to provide revenue certainty for hydrogen projects, with the goal to de-risk DOE's hub investments and spur follow-on investments by solving the supply-demand imbalance we see today. We see this program as critical to providing price transparency and establishing contracting standards across the hydrogen marketplace. The center of this initiative will be an independent, not-for-profit entity that will execute the demand-side program, providing revenue certainty for projects and bringing in the investors and commercial and contracting support expertise that's needed. We envision an independent entity will be very commercially oriented, and they may team up with other private sector entities for specific portions of the program. One of the key roles of the independent entity will be gathering input and coordinating directly with the private sector on the specifics of how this program should look and best catalyze private sector liftoff. We look for this independent entity to work directly with the hubs and address the issues of market liftoff that impact each one. As Kelly mentioned, we're moving quickly to address this issue. Right now, we're focused on finding the right independent entity to help with the hydrogen hubs. This means an organization with commercial and markets expertise that can provide input to the DOE on how to design the mechanism and run a process that serves as a counterparty with supportive projects. As we move into the new year, we will focus our energy on the exact form that this support will take so that we can best support the success of the hydrogen hub projects. So that's some of the context on the overall effort. And with that, I'll pass over to Ramsey from OCED's Portfolio Strategy Division to discuss what we've heard from the respondents to the request for information on this program.
Thanks, Leslie. We'll start off by reviewing the questions we asked in the request for information. And broadly, we asked two types of questions. The first set of questions was around how a demand-side mechanism to support hydrogen hubs should look. That includes what form that support should take, whether it's a pay-for-difference contract, a fixed level of support, or other options. What competitive process should be used to select projects that receive support. How this support should interact with other kinds of support and incentives for hydrogen out there. And how this can be structured to best position the industry for full private sector market liftoff in the future. The second type of question that was asked was around how DOE should implement a demand-side support mechanism, and it's specifically focused on the independent entity that Kelly and Leslie mentioned earlier. Here, we asked about whether there should be one entity or multiple entities involved with administering this program, what capabilities and qualifications an entity needs to be able to implement the demand-side support program, and what, if any, existing entities have these capabilities. We also asked what risks exist to partnering with an entity and how those risks could be mitigated or managed by well-designed governance structures and guardrails. We received over 100 responses to the RFI that contained detailed answers to the questions we asked from a broad range of industry, NGOs, and academia. We're impressed not only by the range of respondents, but also how much work had clearly gone into putting together thoughtful, well-researched answers. So a big thank you again if you were one of those 118 respondents. Okay, let's jump into the findings. There were some areas where we heard broad agreement or majority agreement from respondents, and other areas where there was less consensus. Areas where a healthy majority agreed included the overall need for demand-side support for clean hydrogen. We'd been hearing this before the RFI, of course, but responses confirmed that bankable offtake remains perhaps the trickiest part of developing early deployments of clean hydrogen. Second, a majority of respondents also advocated for either a pay-for-difference or market maker option for support, in which the mechanism makes up the gap between what projects need and what the market is able to bear. Respondents noted that this would be the most cost-effective form of support because it leverages the private sector's willingness to pay for clean hydrogen. We also found pretty broad agreement that, one, this mechanism should be run by a single independent entity with a national focus. Two, demand-side measures should be able to stack with other forms of support, like the 45V clean hydrogen tax credit. And three, that $500 million to $1 billion, while a lot of money, is small in the context of a big commodity market like hydrogen. So we need to be really thoughtful about the highest and best use of that funding. There was less consensus on where support should go. So whether it should go to the producer or the buyer of clean hydrogen or to some other player in the value chain. 2, whether to target hydrogen itself or derivatives and hydrogen-derived products like ammonia, green steel, or things like that. 3, how carbon intensity should be treated in this mechanism. And 4, the longer-term role of an independent entity working on this mechanism. So how are we incorporating these high-level takeaways into the program design? We had a few thoughts. First is that point I mentioned earlier on a mechanism that provides support only for what private buyers will not cover. Second, the RFI confirmed that it is going to take a lot of operational ability and commercial contracting and market expertise for an independent entity to be successful here. Third, while respondents said a single national entity is the best choice for the implementation of this program, we are really focused on how this can account for the regional differences between hubs and hub projects. So we're thinking a lot about how hub awardees can be a big part of the mechanism design and governance. And lastly, we did hear interest from several RFI respondents in responding to a subsequent request for proposal to serve as this independent entity, which gives us confidence that a capable set of organizations that could serve as the entity will respond to the request for proposal that comes out. So now I'd like to get into some of the responses to the individual questions that we asked, starting with that first question on the most effective demand-side measures. As discussed, a majority of respondents supported a mechanism that makes up the gap between a market-determined price and what a project needs to reach final investment decision. We also heard support for figuring out how to support transport and storage infrastructure or hydrogen-ready hardware like hydrogen fuel cell trucks, hydrogen boilers, and hydrogen turbines. This was also an area where we heard the regionality point about the differences between different regional markets for clean hydrogen. As respondents noted that in some parts of the country, there is existing hydrogen transport and storage infrastructure, and other parts do not have that infrastructure in place today. On the best competitive process to select projects, there was less of a consensus view. Many of the developers favored an RFP-like process, but market makers, exchanges, and academics preferred a reverse auction structure, as they said it would best increase competition. A few respondents suggested that you could have the best of both worlds of these two approaches, the request for proposal approach and the reverse auction approach, by having an auction that is designed to avoid any race to the bottom effects that some respondents were worried about, in which bidders might submit unrealistic bids to win the auction and then not actually be able to deliver the project. So that could look like a pre-qualification process for bidders or a requirement for a deposit in order to make a bid to ensure that people are making serious bids to any reverse auction process. Lastly, we'll note that there was a very, very wide range of views on how carbon intensity should be incorporated into selecting projects. We won't spend too much time on the responses to this question, but in general, we heard that the demand side mechanism should be able to stack with other incentives, especially the 45B tax credit, to maximize the impact of this funding. Auction approaches or other methods of selecting supported projects can be structured to make sure that any support from this mechanism is truly making up the gap to bankability for a project versus simply increasing the returns to an already profitable project. Our last question on the mechanism itself was on the best way to structure this so that it can catalyze private sector formation of a mature clean hydrogen market. Here, we heard that publicizing standard offer and contract terms that supported projects receive and the prices associated with that support will be important. Respondents also emphasized just how much work it is to develop these standard contract terms and how that is an area that will require engagement with hundreds or more of the relevant stakeholders here so that the contract that is developed is broadly applicable and commercially relevant. Moving on to the mechanism question. About 70% of respondents who answered this question said that the mechanism should be run by a single entity with national scope. Those respondents emphasized the unique collection of expertise needed to run something like this and the challenge of replicating that across several different organizations versus having it all housed in a single organization that can still incorporate differences between regional markets. As you can see, a few of the skills we heard are needed for this entity include large-scale financial management, commercial contracting law, hydrogen market expertise, project finance expertise, commodity market expertise, and experience working with governments. Based on the RFI, we expect to see some existing groups applying, as well as different teams combining their expertise together to create entities to respond to the request for proposal. We're also thinking seriously about how the selected hubs themselves can play a central role in demand-side support. And we're thinking through both formal and informal ways to make sure the on-the-ground regional perspective they bring to the table is a central part of this mechanism. We also heard a lot from the question we asked on risks to working with an independent entity and ways to mitigate those risks. The basic risks people brought up were around impartiality, data security, and the possible dilution of federal funding if the entity has high overhead costs. We heard a few suggested guardrails here, including making sure the independent entity is a not-for-profit with no commercial ties to applicants, and figuring out how to maintain strong DOE oversight over fund disbursement, while also allowing the third-party operational independence it needs to implement the program. This is an area where we're actively doing more research, and it will be the focus of the second phase that we mentioned earlier on structuring the agreement between DOE and this independent entity. So this concludes our readout from the RFI. Thank you so much for joining, and thank you again to everyone who submitted a response. We're relying on these a lot as we move this initiative forward. And as noted earlier, this is really the beginning of our engagement with the private sector and others on this topic, not the end. Particularly as we move into the mechanism design towards the end of this year and into early next year, we will be working with the implementing entity and the hub awardees to do a lot of outreach and engagement on how this should look to best support the clean hydrogen hubs and the clean hydrogen market scale up. In the meantime, if you do have thoughts, please reach out to us at h2hubs-demand-side at hq.doe.gov. So with that, thank you again, and we look forward to continuing the conversation.